So generally speaking, the economic cycle, and I'll use the ISM survey, Institute of Supply Managers survey from the US as the best guide, has been subdued. So even though we've had equity markets and stuff very strong, the economy's been subdued. So normally a growing economy, you should see the ISM above 50. GDP's actually been reasonably good, but there's something going on in the kind of manufacturing sector that is still sluggish. So the cycle has still been relatively slow, which has created this bifurcation of like tech stocks, which are not based on, debt dynamics or real world expenditures. It's a very separate kind of cash flow that they're earning. The traditional economy has been sluggish. Globally, Europe's slow. They haven't picked up yet either. The UK is a bit of a mess. Canada's slow. And then we go to China, and China's got a full-on debt deflation playing out. So bond yields are collapsing. They can't stimulate because their currency's too weak and they don't want to lose control of their currency. Everybody's desperate for the US to weaken the dollar because the dollar's way too strong for everybody. So the strong dollar usually slows the global cycle. Now, Trump's coming in. The probability is he'll do the same as he did last time, which was the dollar's too strong because the US needs to export goods. And a strong dollar means less exports, which means a larger trade deficit. So we're kind of a little bit in this no man's land where everything is slow. All the forward-looking indicators of the economy are suggesting, because the liquidity that went in and financial conditions over the last 6 months, they tend to be forward-leading, suggest that the economy should pick up significantly this year. Now, China's the one problem child. We have to, as I said, see the dollar weaken, but also the Chinese need room to stimulate. So then they can try and stimulate their economy. Now, the reason they're seeing this debt deflation is the same that we've all had similar issues, is too much debt, aging population, doesn't generate enough GDP growth to service the debts. And what you get is this big problem. And they've got it in the real estate sector, much like we all had back in 2008 and 2012 in Europe. They've got it in the banking system, much like everyone had in 2008 and 2012 in Europe. They've got the same set of problems because their demographics just are falling off a cliff. Yeah, I don't have any structural issues with the US economy. I think that bifurcation of the two different worlds people live in is real. Don't forget the average person is dealing with very high mortgage rates, very high credit card debt interest rates. They're dealing with still low cash flows from their regular businesses. We're not talking about tech giants here who are changing the world. We're just talking about people who run small local businesses. It's still not great. And, we have to get rates lower and stuff for that to happen. And the inflation, yes, the rate of inflation's come down, but the price is stuck. It's still sticker shock every time you go anywhere for dinner. You're like, oh my God, how did this happen? These prices have doubled. So that's a real problem. And what we need is the economy to grow. Now, Trump and his team know this. Scott Bessent is somebody I've known for a long time because he was an ex-hedge fund guy, and he's a friend of mine. I haven't spoken to him for a while, but he understands what needs to be done, and that's we need to get growth. So growth to me is, yes, you need to get interest rates lower. Yes, you need to get the dollar lower. Yes, you need to stimulate the US economy. You need to deregulate the economy. So all of those things on a forward basis suggest that the economy will be much stronger. Whether GDP changes much below, trend rate of GDP growth roughly is about 2% or just below it. We've been trending higher recently. Do we go much higher? Do we have a few periods of 3.5% growth? Maybe, probable. When you have a new administration, there's tax cuts, there's all of that stuff. You tend to do that, and Trump is very driven by the economy more than anything else. So I'm optimistic. Do the Europeans manage to get their shit together or not? That's a different issue, because they are doing the opposite. They just keep increasing regulation, increasing tax, making it harder for people. But they have the difference, they have a social security net. So it's a different structural system. And then we do need China because China buys goods from abroad. They don't just sell them to us. They also buy stuff from us. And if they're on their knees with their economy, they're going to be buying less goods. So we need the global economic system to get fired up. So we need the US Trump to do what he's suggesting he's doing and allow the Chinese to figure out what they need to do. I am not an inflationist. The business cycle, when it picks up, will create some inflation again because oil prices will eventually rise and stuff like that. But I'm not an inflationist. There's two different things going on. There's debasement of currency that inflates asset prices. That's continuing. Inflation itself, I see less so. And all I see ahead is a tsunami of technology that is so deflationary we can't get our heads around it. So yes, we will get business cycle inflation. Where will inflation end up in this cycle? I think it ends up below 2% and then picks up again and maybe gets to 4% and then comes off again. So I'm not wildly concerned by inflation, but as we said, those prices won't fall. So we've still got that issue. But if I look further ahead, I think this is maybe the most deflationary period anybody's ever lived through because of robotics and AI. We're creating infinite people, or people in inverted commas, at zero cost. I mean, Amazon now employs more robots than people. So they're the largest employer in the United States, I think, outside of the Postal Service, or maybe the largest employer. But they have more robots now, and the robots work 24/7, 7 days a week, never complain, never take a tea break.
What is this telling us? Are you concerned at all about the 10-year yield climbing?
I am, because it's tightening financial conditions. It is also decoupled from inflation expectations, so it's not about inflation. So what is going on is every 4 years, all of the major governments around the world have to roll the debt. Now, it's this 4-year cycle, something I call the everything code cycle, because in 2008, there was a debt jubilee of where they reset interest rates to zero. All of the governments, therefore, didn't have to pay interest for a while. So it was a break on interest. So it was like a debt jubilee. It's like, don't worry about it, guys. Don't pay your interest. Sort out your debts. They all restructured their debts into the 3 to 5 year sector. And so 4 years being in the middle of it. And it's created this perfect cycle that's been happening since 2008. What has happened this time around, because we had the pandemic inflation, it's been very late for them to cut rates. Normally in this point in the cycle, they would have cut rates back down to trend rate of GDP growth, let's say 2%, but they couldn't. So what's happening is the debt is now compounding into new debt because they're issuing new debt to pay old debts. And so what you've got is a tsunami of debt that's happening, which is why they need to get interest rates down. So it's that dynamic that's causing it, is the issuance. Something will give at some point. Either the governments are going to have to stop it because everyone's got the same problem, and the UK interest rates just hit it was like a 30, 40-year high. It's unsustainable in highly indebted economies. So they're all going to have to do something. Now, whether it's a yield curve control idea, which is they kind of, as opposed to forgiving all the debt payments, they say, we're going to cap interest rate on government debt at X%. Or you have to do QE, but certainly what they're desperate for is to add liquidity into the system. There's a tightness of liquidity that stops people buying the bonds, which is why the excess issuance isn't being bought. The other issue is the dollar's too strong. So it's expensive for the Japanese and the Chinese and the Europeans to buy US government bonds. So again, it's another reason they've got to get the dollar lower, got to get the rates lower. And then I think it will free up the 10-year. Trump has already said interest rates are too high. And I think Scott Bessent's first job is to figure out this particular mess.
And so where do you see interest rates going, or where do you see the 10-year going? Like, does it go to 5%? And if it does, what does that do to the equity markets?
Look, I think, again, if we talk about the equity market, that bifurcation, I think it makes no difference to Google, Apple, Meta, OpenAI, none of these guys, because those guys compound growth at 30% a year. So a 5% hurdle rate. Don't forget, they all sit on cash. So they actually make more money as interest rates go up, which people don't realize. So I'm not worried about that. If inflation came back, then you have to discount the cash flows. But with rates up, it's not an issue. It is for the regular economy, which creates this bifurcation. And I think that, look, there is a risk that it goes to 5% and 5.5%. So I think there is going to be some pressure from Trump to organize this as fast as possible. The other side of the equation that makes some complexity to it is Trump wants to renegotiate trade terms with everybody, whether it's Canada, whether it's China, whether it's Europe. And the best way to beat everybody into submission is a strong dollar. And so, because they all have dollar debts as well. So what he's going to do is use the strong dollar as the stick and then offer the carrot. And the carrot will be, we will lower the dollar if you agree tariffs or changes in the trade deficits.
How will they get the US dollar lower?
Really, if the US just says it wants a lower dollar, it actually tends to work. The other way is giving access to swap lines to China, Japan, and others who have large dollar borrowings. So that's an injection of liquidity directly into those countries, and then they can recycle that into buying treasuries. That's usually how it works. So there's some way of the US, via the Federal Reserve, lending money into the global system to alleviate the dollar shortage that those people have. They recycle that because they have the dollars, they buy treasuries, and everybody's a winner. So that is the mechanism. So then you ask, well, why are they not doing that? Why is the dollar so strong? It's because they want it strong. And the reason they want it strong is to quickly get an agreement on trade deals. When you listen to Scott Bessent, you listen to a few of the others, one of the other things, why are they talking, what is this nonsense with Canada? What's that all about? It's all about oil. Trump knows, as does Scott Bessent, is we need lower oil price. Even though it's not particularly expensive right now, but a low oil price gets the economic machine working. And they want the Canadians to pump as much oil as possible, the Keystone Pipeline, all of those things. So look, there's lots of moving parts. Some are inflationary, some take time, and others are simple fix. A simple fix is you can add liquidity via either the Federal Reserve or via the Treasury, and you can stimulate assets. So they've got that under their control. So then somehow you need the economy to grow enough via deregulation, but you don't want it inflationary, so you're trying to keep a cap on commodity prices. There's a lot of moving parts here. So look, it's not an easy thing, and we will definitely, as the economic cycle picks up, we will definitely see inflation come back. But the question we ask ourselves is it coming back in a non-cyclical structural fashion, where you see that chart that goes around Twitter all day about the 1970s all over again? Is it that, or is it just a normal business cycle where inflation picks up and then it goes down again?